So I don't know if you guys have been following the news lately, but the Feds just made some announcements that are affecting interest rates. And so one of the big things is, I talked about this over 30, 60 days ago on my trajectories to everybody, so that they would understand that interest rates are projected to be at 4 to even 5% by the end of the year. And so how's that going to happen? And so, it's funny to see how things actually progress and things unfold. And nothing ever fails to amaze me in regards to politics, policies, mortgages, mortgage banking, and the Federal Reserve, so forth and so on, because they're all intertwined together. In fact, the Federal Reserve, being that it's ran by the central banking system and not a non-governmental agency, they say the Feds affected interest rates. And so if you watch the news here over the last couple days, one of the big things is that they made an announcement that raised interest rates by a quarter of a percent. And so that affects people. And the biggest thing is that the rule of thumb for mortgage refinancing is that if you want to refinance your house and you can't save at least a half a point, then it's not worth the cost and expense of refinancing. And so if you go up a 0.25%, that puts us higher. This is higher than we were at the high of this year in April, and we're now higher than we were in the last year pre-pandemic. And so interest rates are rising. And the thing is they are volatile. They could go back down, but the long-term trajectory is for them to rise. And so that affects people and their ability to buy homes. And so if you're looking at either one, refinancing your house, or you're looking to buy a new home, this is going to affect the market. So every time that the interest rates go up a half a point, it changes the ability for a buyer by a $10,000 standpoint on their income level. And so the same house, for example, that you could purchase today, if you were making, let's say, $100,000 a year, you would have to make $110,000 a year to qualify for that exact same house. So every half point that it goes up, it affects the market and who the home buyer is that can pay for that home. So does, you got to understand that over 75% of our US population is only $250 a month away from bankruptcy. So meaning, if they only change by only $250 a month, that over 70% of our US population would go into bankruptcy if it continued for in excess of 3 months. And so when you talk about a half a point on a $300,000 loan can mean the difference of that $250 a month that the 70% of our population would be affected by financially. Why? Because we are a debt-ridden society, right? We love debt. We as Americans we spend more. We have more month left at the end of our money, meaning that most Americans don't make enough each month to support their spending habits, which means it goes into debt through credit cards, car notes, mortgages, and everything else that's available to them. And so understand that when the Feds make judgment calls that increase mortgage rates a 0.25% in one day, and we start seeing trajectories that I've been talking about for months and months and months, that'll affect us at the end of the year. Ladies and gentlemen, this is the time now, in spite of the high market prices, to buy single family homes if you're interested, because they are going to go up. And even the 20% hike that you see, the 16% appreciation that you see in the housing market, the cost to service the debt on that increase 6 months from now is going to be substantially more expensive than it is if you buy today with lower interest rates. So ladies and gentlemen, expect the influx of appreciated mortgage rates. They're coming. We're expecting to see 4 to 5% by the end of the year. Now, will that happen for sure? That's just trajectory. That's not a guarantee. But as of right now, we're projecting to see 4 to 5% interest rates at the end of the year, which is higher than our 10-year trajectory. And so that will definitely affect the housing market, and not only investors, but the end buyers. And so, ladies and gentlemen, if you're able to go out and take advantage of the low interest rates, the time is now. You investors, the time is now.
We can make money off institutional money by exercising the purchase at lower interest rates with other people's money being institutional money, if you exercise it correctly. And ladies and gentlemen, when you use other people's money, including institutional money, that's how you go out and leverage real estate to go out and grow your portfolio with their bank money, and you go out and compound your success.